All right, welcome to Chapter 9, where we talk about the statement of cash flows. We'll go through this at a decent pace, because what I find the easiest is to actually look at some examples and follow formulas and see how things work. So I will also be posting a video about a couple of examples in an Excel file on FOL. So when we talk about the statement of cash flows, really we're going to, first of all, why do we do that? How do we prepare it? How does long-term asset sales come into play? And then what do we mean by free cash flow? So statement of cash flows talks about the fact that, is a company able to pay its bills? Can they purchase new inventory for sale? Can they buy the assets required to run the business? So accounting requirements under both ASPE and IFRS both require a statement of cash flows to track and provide information to readers on sources and uses of cash for a business. So there are always three categories of cash flows that we present in this statement of cash flows. They're operating, investing, and financing. So operating, just kind of day-to-day activities. Investing, where you're putting money back into the business, versus financing, on how you're providing equity or bonds available for the organization, perhaps. So operating is typically the movement of cash within the business as a result of day-to-day activities. All items in that section are directly related to the income statement, revenue and expenses, and the current assets and current liabilities on the balance sheet. So you won't find operating activities touching any of those other components. Investing activities is typically tracking the movement of cash in the business based on movement, whether it's purchase or sale, of long-term assets. Okay, so it's how is the business investing cash back into itself? And just to summarize, the financing component then is how is cash received or paid back to lenders, whether there be banks or shareholders, whatever that might be. And it typically deals with long-term liabilities such as notes payables, equity financing, such as stock. So this chart here on screen just kind of summarizes the different components of the statement of cash flows, where on the left-hand side, we talk about operating activities. So we talk about cash sales and cash collection from customers, cash received from short-term investments, cash received from interest revenue and dividends, cash going out for suppliers, salaries, interest on loans, etc. Financing, there's some examples on here. We receive long-term debt or repay long-term debt, paying dividends out, issuing stock. Investing activities, we sell non-current assets or buy non-current assets. So typically, equipment or machinery, that kind of stuff. There's some examples in the workbook if you want to take a look. So we're talking about the statement of cash flow. There are typically two methods, or there are two methods to prepare a statement of cash flow. There's what we call the indirect method and the direct method. And both methods are allowed under either accounting standard, ASPE or IFRS. The indirect method starts with the operating activities by looking at the accrued net income, and then it adds and subtracts various items. Versus direct method calculates cash flow from operating activities by directly analyzing cash received from sales and collections versus cash spent on expenses. And we'll go through some examples. When we're looking at the statement of cash flows, typically what you want to do is you want to calculate the net increase or decrease in cash during the period. So you look at your cash balances, perhaps one accounting period to the other, so very often year over year. You would then calculate the net cash provided or used by operating if you're using the indirect method. You would then calculate the net cash provided or used by investing, then by financing, and that determines the total net cash provided by the sum of operating, investing, and financing activities. So once you've broken that all up, you will say what the total cash movement is. We would add that to the beginning to get a closing, and hopefully that reconciles to your closing balance sheet for your cash line item. So that's always one of your final checks at the end of the day. So we're going to do an example here in a moment where we will follow this process to use this example of Soho Supplies, who has a year end of December 31st, 2020, We have an example on screen of their balance sheet year over year, split up in a classified presentation, current versus long-term on both sides, assets and liabilities, and then their equity section. We're told that during 2020, land that cost $50,000 was sold for $60,000, so they had a gain on sale of land of $10,000, and that gain was on the income statement on the other income and expenses. And that we'll explain shortly. During 2020, Soho made purchase of equipment for $202,518. You can actually see that right here on their balance sheet, so that ties in. It tells us they didn't sell any equipment; they only purchased some. The bonds were issued at par. So if we look at bonds payable, okay, bonds were issued at par. And what else? Oh, sorry. Soho declared and paid $10,000 in dividends. So the change of retained earnings would be that net income less dividends will equal that change. If we then present the income statement for the year, we've got a bunch of items. We got our sales, our COGS, our gross profit, our OPEX, etc. Then to net income of $653,607. So if I go back a slide, $653,607 less the $10,000 in dividends paid equals the change in the retained earnings year over year. And that's good that we reconcile that component. So that'll come into play on our statement of cash flows. So keep that in mind. So then we'll examine those two statements. And the first thing is, let's calculate the net change, increase or decrease in cash. And we look at cash on their balance sheet, and it changed by a decrease of $46,207. Next is we want to calculate the net cash provided or used by operating activities. And if assets equal liabilities plus shareholders' equity, oops, I think it skipped on me. Okay, so yeah, just remember the formula: assets equals liabilities plus shareholders' equity. Okay, so how we calculate that is we will add back the non-cash expenses to net income and deduct the non-cash increases from net income. So we'll add those components back. So this basic accounting formula is helpful in that case. Okay, so if cash plus non-cash assets equals liabilities plus shareholders' equity, move the algebraic formula around, cash is equal to liabilities plus shareholders' equity less the non-cash asset. So thinking about as we split the asset piece into cash and non-cash, we can then say any changes in cash on the left side equal to the changes in liabilities plus the change holders and shareholders' equity less the changes in non-cash assets. So hopefully that'll help you just picture how those changes impact each other. So our cash flow from operating activities in this example, we look at our non-cash and non-operating items, which might include depreciation, gains or losses on sales of assets, any gains or losses on retirement of debt, and those must be canceled by adjusting the net income. So we have our net income of $653,607. We have to add back the depreciation because it's a non-cash item. And we need to subtract the gain on sale of land because that's considered investing, which we'll talk about later on. And you can see this last column called updated cash balance. That's not usually on the statement. It's just there for demonstration purposes as we go to show the impact of these items on cash. Okay. So this column is just for demonstration purposes. So then the cash flow from operating activities under the indirect method always starts with net income and then adds or subtracts certain items from the income statement and some changes on the balance sheet. So our what we just mentioned before, we add the net income of $653,607. So if that was the only thing that happened all year, we would have ended with cash of $1,049,749. Okay, and you would go through the other two items. Once you've done that part, then is you go on to the changes in operating assets and liabilities. So typically they include AR, prepaids, inventory, AP, maybe you have salaries, interest payable, and any tax payable. This is all part of day-to-day operations. So we look at those changes, and depending on whether they went up or down, on how they did affect cash flow. So let's go through each of these. in some verbiage. So item D, which if we look at the previous slide, was the AR. Item D says if accounts receivable increases, that means the customer hasn't paid us yet. So therefore, if our current assets go up, we're actually using cash to offset that increase in those current assets. So anytime a current asset increases, we're using or consuming cash. That's assuming liabilities remain the same. So D, E, and F are all the same. Prepaid insurance increase, inventory increase, and AR increase. They're all consuming cash. So if we go back to the previous slide, they all have to be reductions in the cash available. Going forward on the AP side, on our accounts payable increase. So if we owe our vendors more, it means we didn't pay them yet. That means we're keeping cash available for our use. So if we go back to the partial statement of cash flow, you can see that that actually generated cash. By not paying our vendors quickly, we generated $307,000 of cash available to us. And you would go through the other payables similarly. AP increase, salaries payable decrease. So salaries payable decrease, that means we paid more cash to staff. Interest payable decrease, therefore we paid off the interest payable. Income taxes payable increase, that means we kept the cash on hand. And therefore the updated cash balance decreased by $77,689 from the beginning balance of $396 to a balance of $318,453 just because of operating activities. So we're not done yet, but based on operating activities, if we go back 2 slides, if that's the only thing that we did for the year, we didn't invest, didn't finance, our cash would have been $318,453. Let me catch up. All right, so here's a little slide that talks about what I just mentioned, where if current assets increase, we deduct from cash flow. If they decrease, we add to cash flow, et cetera. Okay, so hopefully this will help explain in a visual picture what the impacts of those changes are. Next, we would calculate the net cash provided or used by investing activities. That's typically by selling fixed assets or investments or intangible assets. It could be a goodwill or other item. So in this case, we made proceeds from sale of $60,000 and we add that to the updated cash balance because that's money we made. That's the cost of $50 plus the $10,000 gain, all comes under investing. The purchase of equipment is a straight investment in the company of $202,518. So that's consuming cash to invest in the business. So therefore, we actually consume cash for investing activities. You can see on screen here the snippet of $142,518. Next is we calculate the net cash provided or used by financing activities. Those financing are typically, we issue shares, we make dividend payments, maybe we make bank loan or principal repayments. So if we look at the liability section of the balance sheet, you can see that the notes payable was a total change of $204,000 increase. Therefore, our notes notes payable increased by $204,000. Let's summarize up the items that will be in this section. We have notes payable, current plus long-term. You would present them as one item on your statement of cash flows. They increased by $204,000. Therefore, we borrowed more money, more cash available. Our bonds payable decreased by $30,000. That means we paid some back to our lenders. So that consumed cash. Dividend payment consumes cash. The preferred shares increased, so we issued more. Therefore, we collected money for issuing those preferred shares. So if we look at the section on financing activities, we have the 204 in, the 30 out, 10 out, and the 10 in for those 4 items. So the net cash provided by financing was $174,000. So adding this all together, hopefully you can see it on screen, is now we have the 3 sections: operating, investing, and financing. So when we take those And that'll determine the net change in our cash in the year, which you hopefully see on screen was a decrease in cash of 46,207, added to our cash at the beginning of the year, 396,142, better equal our balance sheet of 349935. If that doesn't, you might have a sign backwards, adding or subtracting things, or maybe you missed the line item from the balance sheet, perhaps. That does happen often. So that ties into step 6, is just verifying that those items balance. The next thing that you see on screen is sometimes you might have a non-cash transaction. Those have to be disclosed in the notes of the financial statements. So what that means is you might, get gifted something, no change of cash. There's no change in position of the company, but there is a non-cash transaction. They'd be summarized in one line item at the bottom of the statement of cash flows. Okay, so just keep that in mind as we continue. Why is this not? There we go. Something to know is whenever we sell long-term assets that depreciate, you have to remember that determine the assets at book value is important. Okay, when we're looking at the cash flow, because the book value, there will be two components, and the cash component is the cash collected versus you might have an original cost that you're removing as well as the accumulated depreciation that's being removed. Okay, so you want to make sure that you're looking at both of those line items as we go. And again, we'll do some examples. This is just demonstrating that the income statement also provides information on long-term assets, specifically depreciation expense, but also the loss and gain on sale of equipment. So that comes into play. You need to keep those numbers in mind when you're looking at the change in capital assets. So when you're actually looking at the amount of cash received, we must determine the book value of the asset by examining the changes in its related balance sheet accounts. So specifically, in this example, we have equipment had an opening balance of 170. We know we purchased 375 in this example on screen, but our closing balance is 420. So that tells us that the difference of 125 has to be the original cost of the sold equipment. Similarly, on the accumulated depreciation, if our opening balance was 36, our closing balance is 61,262, and our depreciation per our income statement, which is why that comes in handy, 43,262, that tells us the depreciation on that sold equipment was 18, because we have to back out those relative components. So therefore, the original cost, 125, less the depreciation on that item that was sold of 18, gave us a book value of the item of 107. And once we know that there was a $16,000 gain, it tells us we received $123,000 in cash. That's how you back in to the cash that you received. So looking at long-term investments, long-term investments held at cost were also sold during the year, and that's shown by the decrease on the balance sheet. So the income statement indicates that there was a loss. So therefore, you look at the balance sheet, you can tell they sold, but you can see a loss on the sale on the income statement. So similarly to the equipment, we had the opening balance of 500, closing balance of 400. Therefore, we got rid of $100,000 of investment, but we have a loss on sale under our other income and expense section on the income statement of 5,000. Therefore, we only received $95,000 from the sale of that investment. Okay, so that's why that other income and expense section, very often, most of it belongs somewhere else, not under operating on the statement of cash flows. Okay, and again, exercise application questions will help reinforce this. So in this case, our cash flow from investing activities would be the sale of equipment, 123, the sale of investments of 95 that we just did the calculations on. The purchase of equipment in this example, you just saw 2 slides earlier of 375. But for the net cash used for investing activities into the organization were 157. So the last kind of topic to talk about is free cash flow, and it's the amount of cash remaining after a business has covered all of its operating and capital activities. So capital activities are where they invest in long-term assets. Any of that remaining cash is then free to reduce debt, buy back shares, pay dividends, etc. So that's considered free cash flow. So free cash flow equals net cash flow from operating plus any net cash flow from investing. So it's the difference of those two. So Soho Supply's cash flow statement for the year ended December 31st, 2020 showed a decrease in cash flow from operations of 77,689 and a decrease in cash from investments of 142,518. So their free cash flow is actually a negative. They consumed cash in operating, they consumed cash in investing, therefore they actually had to borrow money from the financing side to cover it off. Otherwise their cash would continue to decline, which they might have used cash, but very often they would use financing to try to balance off their cash side. Okay, there's some examples here, and just pop over to the other video, and there's also an Excel file I posted on FOL that you can hopefully follow some of the formulas and how they talk to each other, income statement, balance sheet, and to the statement of cash flows. Recorded question 10 and 14, so I encourage you to take a look at those.